All right, today we're going to talk about something that might sound a little controversial. We're going to take a hard look at one of the most popular investment strategies out there and ask, is it actually a hidden trap? I mean, really think about it. What if the very strategy that 99% of financial advisors tell you to follow is actually working against you? It sounds a little nuts, I know, but stick with me because we're going to look at the S&P 500 through a totally different lens today, and the numbers might just change your mind.
And to really get our heads around this, let's just simplify it all. Let's tell a little story. Imagine there's this group of monkeys, right? And they stumble upon this incredible, magical banana tree. They think they've hit the jackpot. I mean, it seems like the answer to all of their problems. But as you'll see, there's a catch they just don't see coming.
So in our story, this magical tree, well, you guessed it, it's the S&P 500 index. It's the gold standard, the benchmark for the US stock market. And honestly, it's become this legendary thing. You've got all the financial advisor monkeys swinging from the branches, yelling at everyone to just put all their bananas under this one single magnificent tree. And why wouldn't they? I mean, look at that number. Since 1957, the S&P 500 has churned out an average annual return of about 10%. That is a seriously powerful number. It promises this incredible, almost automatic growth over time. It's the kind of thing that gets anyone with a brokerage account really, really excited.
And this is that beautiful magic of compounding we hear about all the time, right? You see those charts that just sweep upwards and to the right, showing how a small investment can just blossom into a fortune? And this quote, "It's financial poetry," that just captures the feeling perfectly. It really is, when it works. But here's the big question. Does it always work the way that pretty chart suggests?
And this is where our story takes a little bit of a turn. Because while all the younger monkeys are down there celebrating, there's a wise old silverback gorilla just watching from a distance. And he's a little concerned. He's seen a thing or two, and he sees something that the others are completely missing. He knows that this magical tree has, well, let's just say it has some very peculiar habits. And this is exactly what that silverback sees. He knows the tree doesn't just grow smoothly. Nope. Sometimes it violently shakes and drops all its bananas at once. We saw it in 2000 with the dot-com bust, a 50% haircut that kicked off what they call the lost decade, a whole 10 years where the market basically went nowhere. Then, boom, 2008 happens, another 40% drop. And even the COVID plunge in 2020 was a gut-wrenching 34%. Real compounding needs consistency, and this is anything but. So let's get into it. Let's see how this all builds up into a trap. We're going to start with the simple but pretty perilous math behind these wild market swings. Okay, let's make this super simple. Let's say you have $100. The market crashes, just like it did back in 2000, and you lose 50%. Ouch. Now you're left with just $50, a really brutal drop. Now pay attention because here's the real kicker. This is the heart of the trap. To get from your $50 back up to your original 100, a 50% gain isn't going to do it. Not even close. You need a 100% gain. You have to literally double your money just to get back to where you started. This isn't an opinion, it's just cold, hard arithmetic. And it's exactly why volatility is the silent killer of wealth. This whole idea leads to a really critical concept called sequence of returns risk. All that means is that when your losses happen, matters a lot. Think about it. A 40% drop when you're 25? Awesome. It's a huge buying opportunity. But that same 40% drop the year you plan to retire, when you need to start pulling money out to live on, it can be absolutely devastating. It can permanently damage your entire financial future. The timing, the sequence changes everything. But, this trap isn't just about the math. There's a human side to it, a whole psychological piece that honestly makes things even worse. This is all about the huge gap between how the stock market performs and how you, the actual investor, perform. Just look at these numbers. They're staggering. Over a recent 20-year stretch, the S&P 500 gave investors a return of about 9% per year. Pretty good. But the average person invested in those funds, they only got about 4%. So what happened to that other 5% every single year for 20 years? Where did all that money go? All the answer is right here. It's behavior. We humans, we get emotional. Our monkeys in the story, when that tree starts to shake and drop all its fruit, they absolutely panic. They flee the tree, selling everything right at the bottom, and they lock in those massive losses. They sell out of fear.
And then they usually only feel safe enough to buy back in after the best part of the recovery has already passed them by.
So, if putting all your faith in this one single magical tree is a trap, what's the answer? What do we do? Well, this is where we finally listen to the wise old silverback. He knows you don't run away from the jungle. No. Instead, you plant an entire orchard.
In the silverback's wisdom, it really boils down to 3 simple core ideas. First, you have to diversify. Don't put all your hope in one single tree. Second, you have to actively manage your risk. You need a game plan for when the storms inevitably come, instead of just closing your eyes and hoping for the best. And third, you have to have realistic expectations. You gotta understand that markets go up and down, and you plan for that reality instead of chasing some fantasy of perfect, uninterrupted growth. So what does a real-world orchard actually look like? Well, it means looking beyond just the big US companies in the S&P 500. It's about planting all different kinds of trees. We're talking international stocks to get growth from outside the US, smaller companies which have totally different growth cycles. It means including other kinds of assets like real estate. It can even mean focusing on things like value stocks, solid, maybe kind of boring companies that are temporarily on sale. The point is, each of these performs differently in different economic seasons. This smooths out the journey and helps make sure you've always got some fruit coming in, even if one tree is having a bad year. And really, that's the big takeaway here. The S&P 500 isn't evil. It's not a bad investment. It's an incredibly powerful tool. But it has to be just one tool in your financial toolbox, not the entire toolbox itself. Real wisdom is knowing you have a bunch of different tools and knowing which one to use and when. So, as we wrap this up, I want to leave you with this one question to really think about. When you look at your own investments, when you look at your own portfolio, what do you see? Is it a single magical tree that you are 100% dependent on? Or do you see a diverse, resilient orchard, one that's built to handle whatever the market throws at it?